So I promise you, this is going to be one of the most important charts that you could read and understand because it doesn't just have to do with Roth conversions. I'll show how Roth conversions come into play with this, but this will also help you understand how marginal tax rates work and how taxes in general work. I'm going to keep it somewhat interesting, but it's definitely going to be technical in the same breath. So what generally happens is an individual has gross income. That's the income that they're making throughout the year. If they own a business, if they have W-2 income, whatever that is, that's their gross income. The difference between gross income and adjusted gross income is something known as above line deductions. So when I used the example and I said, if I make $100,000 in a given year and I put $5,000 into my IRA, which is a pre-tax IRA, a deductible IRA, that means that that difference, that $5,000 that I placed into that pre-tax qualified account, reduced my gross income. So it now layers down to my AGI, my adjusted gross income, being $95,000 in that example. If I had no above the line deductions, then my gross income and my adjusted gross income are going to be identical. So I hope that that makes sense. What you'll notice is right next to adjusted gross income is something known as modified adjusted gross income. I'll get back to that, but just I want to teeter down this scale. So we understand gross income minus above line deductions equals your adjusted gross income, your AGI. If, let's say, you don't have itemized deductions and you have to go with the common standard deduction, which the Tax Cut and Jobs Act increased the standard deduction for families. Excellent. It also decreased the marginal tax rates. Excellent. That helped out. The problem that's occurring is if Congress does not change anything, that Tax Cut and Jobs Act is going to sunset on December 31st of 2025. So these numbers that I'm showing you, this is for 2024 numbers, but be mindful that it could be adjusted with different inflation and different things. And based on what Congress does from now until December 31st of 2025, you might be going back to the old rates. But we understand gross income minus above line deductions equals adjusted gross income. Minus the standard deduction equals what your taxable income is. So that's the income that is calculated on what marginal tax rate you have to pay. So if, let's say, you go and somebody has adjusted gross income of $100,000 and they have a standard deduction of $20,000, just as a hypothetical example, their taxable income is going to be $80,000 in that example. It's adjusted gross income minus the standard deduction. Whichever is higher, itemized deduction or standard deduction, that's what you're going to use when you're filing your taxes, and that's how you get to the taxable income amount. If we stay on that example that somebody's taxable income is $80,000, how does that work in conjunction with the charts below that? And these charts, the numbers that it's showing is for a married couple. So if you're looking at this saying, I'm single, this numbers look off. These are for married couple for the 2024 tax year. What happens is the first $23,200 that you make as a married couple is going to be taxed at the 10% bracket, or the 10% rate. The next, we'll call it, $56,000 and change to get up to that $80,000 amount. That's going to be sitting at the 12% bracket. So if we look at this, we notice that from $0 to $23,200, that's going to be taxed at 10%. From the next $23,201 to $94,300, that's going to be taxed at 12%. If you make more than $94,300, if your taxable income is showing more than $94,300, then you're going to spill over into the 22% bracket. That's important to note because if we're trying to leverage Roth conversions and we understand what your taxable income is, well, it might make sense to only fill up the 12% bracket. Or if we teeter down these scales and we understand a larger jump might be 24% to 32% bracket, we might want to only fill up what that 24% bracket is. Because if we tilt over into the 32% bracket as an example, and you're converting large bulks of Roth conversions, those extra dollars are now going to be taxed at that 32% rate and possibly into the 35 and possibly into the 37% rate. So I hope that this makes sense. If we're looking at it, somebody has taxable income of $80,000 after the gross income, after the adjusted gross income, after the standard deduction, their taxable income as a couple is sitting at $80,000. We understand that a portion of their dollars is going to be taxed at 10%. The next portion of their dollars is going to be taxed at 12%. In that example, we have it's $80,000. We still have $14,300 that you could use up in a Roth conversion to stay within that 12% bracket before it gets tilted over into the 22% rate. So these little upscales of charts, be mindful that if you don't want to have large jumps, maybe only fill up the 12% bracket, or maybe only fill up the 24% bracket, or maybe only fill up the 35% bracket. So those are these little rule of thumbs to make sure that if you're converting too many dollars, anytime you do a conversion, that's going to increase your taxable income. So as an example, if I made $80,000 in a given year, but then I did a conversion of $100,000, well, now it just spilled me over into the 22% bracket, and anything that I'm making above $94,300 that's showing as part of that conversion, everything above that line is now going to be taxed at the 22% rate. So I might want to incrementally do that conversion, or maybe 22% is not that bad and you want to fill up that 22% bracket before you spill over into the 24% bracket. So that all that makes sense. And let's go with another example. Let's say that somebody's making $250,000 in a given year. If they're making $250,000, well, we understand that they're going to have a portion of dollars taxed at 10%, a portion of dollars taxed at 12%, a portion of dollars taxed at 22%, and then they're going to have roughly about $48,000 that's going to be sitting at the 24% bracket. If they want to try to fill up their bracket, well then, and they have $250,000 of taxable income, and they want to stay within that 24% bracket, well then we understand that they have that spacing of about $133,900 that they can do of conversion monies incrementally to stay within that 24% bracket. And you could play with this a few different ways. You could play with this with multiple different examples. And this is what we're doing behind the scenes to make sure you're not shooting yourself in the foot. You don't see this nice, beautiful $1 million IRA and you say, I got to go and convert the entire thing, but I'm going to do this blindly. No. You want to make sure that you're doing incremental Roth conversions. You're doing it the proper way, and you're figuring out what are my tax rates, or what are my projected tax rates going to be, or what is my income going to be throughout retirement to make sure I could cover my expenses. And if that number is higher than what the tax rates are right now, it could make pure mathematical sense to leverage that Roth conversion. There's a lot of different benefits between Roth conversions, one of them obviously being tax-free income, and then also how it has the effect on modified adjusted gross income. But just for simplicity purposes, you could try to leverage something known as a tax equilibrium. If rates are going to be lower in the future, well, then it might not make sense to do the Roth conversion now. If rates are higher in the future, well, then you probably want to hoard more dollars in Roth conversions now than in the future. Maybe somebody that has variable income and they work off of commissions, or their business is not doing so well this year. Well, maybe that could allow you to convert more dollars to fill up those brackets, and you could do it at a variable rate, or a Roth conversion cost averaging strategy where you're doing it incrementally multiple months throughout the course of the year, as opposed to one lump sum chunk at a given time. So there's so many different nuances with this, but I just want you to understand how the 10% fills over into the 12%, which fills over into the 22, which fills over to the 24, which fills over to the 32, which fills over to the 35, and then you're maxed out on a federal rate, that 37% bracket. Now, understand, based on whatever state you're in, you could also have another upwards of 10% in taxes by doing these conversions. So you want to be very careful and make sure that you're at least, taking advantage of the Roth conversion analysis that we do for individuals that call into the agency.